Most business owners make the mistake of thinking that after they sell their business, their tax pain ends. It doesn't. The reality is, it just changes form. Your business sale may be behind you, but your portfolio becomes a tax sinkhole the day after closing. Rebalance your portfolio? Taxed. Earn high income off a public or private credit fund? Taxed. K1 from a private fund? Taxed. Future rolled equity capital gain? Taxed. Here's the problem. Most newly liquid business owners, they don't see these tax sinkholes until it's too late. If your investment strategy isn't engineered correctly, taxes can drain millions out of your portfolio over time. So if you think our government is efficient with your tax money, just shut this video down and let your portfolio hemorrhage out. But if you want to take control of your financial future, compound your wealth, and avoid these tax sinkholes, this video is for you. The right investment tax strategy is often the difference between running out of money or doubling your net worth. I'm going to walk you through a portion of our proven framework that we've used to save our clients tens of millions of dollars by eliminating this tax sinkhole. So how do we know that this works? Well, just over the last 16 months, our clients have executed over 500 million in business sale transactions. These are institutional investment tax strategies. So I started my career as a CPA and then spent 17 years investing on Wall Street and helping to manage money for some of the largest institutions in the world. This is episode 2 in our 3-part series on how to pay less tax and make more money after a business sale. In episode 1, we walked through how we saved a founder $3 million on a $35 million business sale using long-short tax loss harvesting. Today, we're digging into the tax sinkholes in conventional portfolios that are typically managed by outdated wealth managers who don't care about your taxes, nor do they have the tools. Hey, I get it. Tax isn't necessarily sexy. But what I want to do is have you avoid those sinkholes so you can compound your wealth without hemorrhaging cash year after year. As Charlie Munger says, the first rule of compounding is to never interrupt it unnecessarily. One of the biggest interruptions, paying unnecessary taxes. So let's break it down so you avoid that mistake. Let's jump into 3 areas where I see tax leakage in portfolios. So let's set the scene here. You have a $40 million portfolio. $26 million of that portfolio is invested in stocks and ETFs that represent stocks. You have an additional $6 million that is invested in fixed income or bonds. And then the remaining $8 million is invested in alternative assets. That could be hedge funds, it could be private equity funds, it could be private credit or private loan funds, or any variety of alternatives, typically in the private form. So 26 million in stocks, 6 million in basic fixed income, and another 8 million in alternatives for a $40 million portfolio. I want to address these portfolio tax issues one by one. Let's start with rebalancing the portfolio. So in that rebalancing example, taking the stock or ETF portion of the portfolio that has direct investment exposure to global stock markets down from 26 million to 22 million, which then generated a $2 million capital gain and $740,000 in taxes. So let's talk about that. Instead of having 22 million or even 26 million invested in the broad stock market, instead, if there was just $3 million invested in the long-short tax loss harvesting strategy, that could eliminate the $2 million gain from rebalancing the portfolio. Let me tell you about how this works. We've talked about it in prior videos if you want a detailed breakdown to go through step by step, but I'm just going to give you the results in this video. So imagine you have this $3 million, and the goal of the $3 million is not just to match the overall performance of the stock market, but it's to outperform. And the manager that we deploy has a reliable track record of doing so. And while outperforming the stock market, they're also generating these realized capital losses, or what I call tax assets, that can be used to solve other issues in the portfolio, such as this big gain that was created by the rebalance. So let's break that down. On a $3 million investment, being made in long-short tax loss harvesting as a part of an overall portfolio approach to grow the assets over time. That would also generate around $2.2 million of realized capital losses. So let me tell you about these realized capital losses. These are capital losses that come through on a 1099 form produced by Fidelity, a $9 trillion custodian. These are the types of losses, or if there were gains in this 1099 form, where if you don't report these to the IRS, you get a letter from the IRS. So there is absolutely nothing that's close to any gray lines on this strategy. So the long short separately managed account produces 2.2 million of realized losses, which is a direct offset of the $2 million in gains that you're producing from that rebalancing. So that $740,000 tax bill, that goes away. And now that $740,000 can continue to compound as a part of your overall portfolio, as does the long-short tax loss harvesting account. Let's move to the second tax problem that are common in portfolios, and that's capital gains that are delivered from a K1 from a private fund. So let's say in this example that in year 2, you get $600,000 in capital gains reported on K1s due to private funds that you own. Again, these could be hedge funds, private equity funds, all types of different investment vehicles that produce K1 forms and capital gains, despite the fact that you didn't sell those private funds. So if you have this long-short tax loss harvesting portfolio of $3 million, this $3 million portfolio realized $2.2 million of realized losses in year 1, of which $2 million was used to offset the gain due to the rebalancing we discussed earlier. That remaining $200,000 that wasn't used, that actually carries forward and never expires and can be used on future capital gains. So in year 2, you receive K1s on this $40 million portfolio of $600,000. And without proper tax strategy, such as this tax loss harvesting portfolio, you would just go ahead and pay over $200,000 on those capital gains from the K1. However, you have $200,000 in carry forwards losses from the prior capital losses, and then the long-short tax loss harvesting portfolio is likely to generate over $1 million of new realized losses in year 2. So approximately 1.2 million now in realized losses by the end of year 2, of which half of those, or $600,000, can be used to offset these taxes from K1s of private funds. The third area of tax issues that I see in portfolios is related to ordinary income. And anyone who knows anything about tax or about their taxes they pay every year know that ordinary income is the worst, okay? It's the worst because it has the highest marginal tax rate. In California, it's 54%. In other states, it's 37%, just given the federal tax rate. And not only is the tax rate the highest, but it's the hardest to offset. You know, in business, you operate a business, you can do certain strategies, but once you sell your business and you're just left with this pile of cash and investments, it becomes much more difficult to offset ordinary income. Luckily, there's been a number of tools developed over the last 5 to 10 years that allow portfolios that are managed in a tax-conscious way to offset substantial ordinary income and all of the ordinary income in this $400,000 example that we've been running with on this $40 million portfolio. I want to relate this to a live client example who was generating $400,000 of income from his portfolio from a $30+ million business sale in 2024. Our portfolio design doesn't look the same as the one that I outlined earlier. It looks quite different, but $400,000 was the estimate of ordinary income as we headed in to 2025. So let's break down what we did, the exact strategy to eliminate this $400,000 of ordinary income. When it comes to reducing ordinary income, I think of it as a 3-legged stool. The first leg of the stool is our old friend, long short tax loss harvesting. And for this particular client who is going to generate $400,000 in estimated ordinary income during 2025, we deployed $3 million in long short tax loss harvesting. If you're paying attention, you're probably thinking, well, wait, long short tax loss harvesting generates capital losses. How can I use capital losses in order to offset $400,000 of ordinary income? You're right, you can't. And that's why it's a three-legged stool and not a one-legged stool. So the long short tax loss harvesting does produce these realized capital losses year after year that persist. So approximately $2+ million in year one, another $1 million in year two, over $700,000 in year three before leveling out. Okay. So now we have these realized capital losses, and we can use those capital losses to offset capital gains if they have them. But we can also deploy further investment tools, or these other two legs of the three-legged stool, in order to generate ordinary losses. The other two legs of the stool are tax-aware hedge funds. And a hedge fund is nothing but an investment partnership where the money manager is the general partner and you, as the investor, are the limited partner. Anytime you have a limited partnership, similar to our other private fund examples, you receive a K-1 at the end of the year. And on that K-1, you're going to have all of the various tax components. You're going to have ordinary income, ordinary losses, capital gains, capital losses, expenses of the fund, et cetera, et cetera. And that's all going to come through on this K-1. So the two legs of the stool, let's call them tax-aware hedge fund 1 and tax-aware hedge fund 2. So let's focus first on tax-aware hedge fund 1 and the investment strategy and the tax treatment. So tax-aware hedge fund 1 is managed by a firm that manages $160 billion, typically on behalf of institutional investors like large endowments, pensions, and they also manage the long-short tax loss harvesting strategy. So tax-aware hedge fund 1 has an investment strategy. And look, this is an investment strategy first, and the goal is to generate returns. Over the past 6 years, this fund has generated returns of 15% compounded over that period. So what that means is they didn't do 15% every year, but from point 1, 6 years ago to now, the average compounded return has been 15%. So excellent returns. And those returns aren't just because the stock market is up, because that fund has only a 0.4 correlation to the US stock market. So it provides a diversified investment portfolio versus most folks' largest holding, which is the US stock market. So what this strategy does is it is long equities, short equities, but also has a third of the portfolio that is a diversified strategy that's quantitative based. I won't get into all of the details of that strategy today, but the returns have been good and uncorrelated, providing valuable diversification over its existence. So in this fund, Tax-Aware Hedge Fund 1, at the end of the year, you get a K1 audited by KPMG. And on this K1, that fund is targeting long-term capital gains of around 30% of whatever your investment is in that fund, as well as ordinary losses of 30% of the amount that's invested in that fund. So let me give you an example. For our client, we had a $3 million investment in long-short tax loss harvesting, and then we added a $500,000 investment in Tax-Aware Hedge Fund 1. And so far during 2025, and there's still 3 months remaining from the last statement, this fund on a $500,000 investment has produced only $15,000 of long-term capital gains and around $110,000 of ordinary losses. So on this $500,000 investment for the year, we would expect around $150,000 of ordinary losses and $150,000 of long-term capital gain. And this is a real investment strategy, so the results are going to be variable, but the gains are coming in far lower than expectations due to smart gain deferral strategies, and the ordinary losses are coming in relatively in line with expectations. So what happens is that since we're generating so many realized losses from the long-short tax loss harvesting account, those wipe out this $15,000 in long-term capital gain, and we're left so far with a $110,000 reduction in ordinary losses, which I expect to grow over the coming 3 months. As it relates to performance, you have the tax benefit, plus this fund is up another 15% this year. And early in the year, when the US stock market was down over 15%, this fund was up 10% already through April. Now, the third leg of the stool to reduce ordinary income is tax-aware hedge fund 2. So tax-aware hedge fund 2 is similar to the characteristics of tax-aware hedge fund 1, but the tax impact is far greater and the return expectation and volatility is lower. So let me give you an example. Tax-aware hedge fund 2 has generated around 6% returns over the past 6+ years, whereas tax-aware hedge fund 1 has done 15%. However, tax-aware hedge fund 2 also receives a K1 at the end of the year, again, audited by KPMG, and the tax implications are large. For instance, short-term capital gains are likely and estimated to be about 130% of whatever the investment is in tax-aware hedge fund 2, and they're short-term in nature, whereas ordinary losses are also expected to be or targeted to be 130%. They're not that every year. Sometimes they're lower. Sometimes they have been far greater when you go back and you study the historical K1s. But let me give you an example. So let's say you have a $500,000 investment, which is what we executed on our client's behalf in tax-aware hedge fund 2. The targeted short-term capital gains on a $500,000 investment, $650,000. And the ordinary losses on a $500,000 investment are $650,000. So let's say you combine tax-aware hedge fund 1 and tax-aware hedge fund 2. So tax-aware hedge fund 2, we just mentioned, is a $650,000 short-term capital gains. If you add that to the expected long-term capital gains of tax-aware hedge fund 1, the total is $800,000 in overall capital gains. That $800,000 of capital gains coming through that K1 can be completely offset by the $3 million investment in long-short tax loss harvesting, since it produces in the first year around $2,200,000, and in the second year it continues to produce well over $1 million. So you're continuing to offset those capital gains from those two funds. Further, you now have $800,000 in ordinary income since the capital gains have been taken care of by the long-short tax loss harvesting strategy. And this $800,000 can be used to offset any type of business income, investment income, and even W-2 income, although that's not the purpose of this conversation, up to a certain limitation. And the reason is because these are active trader funds, and active trader funds can be used to offset active income anywhere in a client's life. It doesn't have to be passive income like real estate and depreciation, which is commonly discussed by clients. So this three-legged stool, long-short tax loss harvesting, tax-aware hedge fund 1, and tax-aware hedge fund 2. I apologize. I'm not that creative when coming up with names, only tax strategy. This $4 million investment in this three-legged stool can produce over $800,000 in ordinary income tax reduction. So you might be thinking, you mentioned that the ordinary income was only going to be $400,000. What happens to the rest? So that $400,000 can be carried forward into the future to offset future ordinary income, depending on the situation, sometimes up to a limitation. Similar to tax-aware hedge fund 1, we can track the real-time results up to the last quarter of tax-aware hedge fund 2. So tax-aware hedge fund 2, in the current year, this live situation from a business sale from last year, it's already produced over 130% of short-term capital gains and also 130% of ordinary losses. So the short-term capital gains are over $650,000 on this $500,000 investment already. And The ordinary losses from this fund that will come through on the K1, those are also over $650,000 so far in 2025. And from an investment performance on tax-aware hedge fund 2, the performance has not been good this year. It's actually down 3.3%. But when you think about the tax benefits that it's producing, so $650,000 of ordinary losses for this particular client, that's going to save them, just from that fund alone, over $240,000 on taxes. So this small loss in the current year is more than offset by the tax savings in order to generate an overall attractive after-tax rate of return. So think about those numbers. If you have a $500,000 incremental investment on tax-aware hedge fund 2, even though it's down 3.3%, which is $16,500, it's also leading to $240,000 of cash tax savings during 2025. So I'm not great at math, but that's almost a 50% return by adding tax-aware hedge fund 2, or this third leg of the stool. So this is why I preach to everyone. I don't care about your pre-tax returns. I care about your after-tax returns. Because look at that example. Pre-tax, negative 3.3%. After-tax, plus 45%. So let's review this three-legged stool that we deployed for our client. $3 million invested in long-short tax loss harvesting that has already generated over $2.2 million in realized losses and has grown to $3.6 million because of investment performance. The second stool, tax-aware hedge fund 1, has grown to $575,000 and is on track to generate $150,000 of ordinary losses, since the capital gains it generates will get offset by long-short tax loss harvesting. And finally, the third stool, tax-aware hedge fund 2, that balance has declined to around $485,000, but has already produced over $650,000 of ordinary losses and $650,000 of short-term capital gains, which will again be offset by long-short tax loss harvesting. So in summation, there's been $800,000 of ordinary income eliminated. And if we just apply, again, back to the trusty 12C here, if we just apply a 37% federal tax rate to that, that's about $300,000 of cash tax savings. And due to the investment performance of these three legs of the stool, which has increased from $4 million to $4.7 million, if you add that $300,000 of tax savings that can be used either this year or into the future, now you're at $5 million on a $4 million investment, but on an after-tax basis. So $5 million divided by $4 million, that's a 25% return over 2025 due to smart investment planning first, but also tax mitigation strategies to really maximize after-tax returns. I realize this is very technical and there's a lot of moving parts. And frankly, the tax savings are so large and the long-term benefit is so great, you're probably thinking it's too good to be true. Like, I get it. When I first started studying this years ago, I had the same impression, and I'm a CPA and spent 17 years investing on Wall Street. But if you want to have a private conversation about how this might relate to your situation, feel free to go to the comments or the notes of this video and find my email and contact information that we can discuss discreetly.